You can make a lot of money if you're on the right side, but most people, I think, lose. Can we go back a step, John? Can you explain to everybody here, explain to the audience, this is really important, because I'm sure a lot of them probably want to dabble in options because you can make a lot of money if you're on the right side, but most people, I think, lose. I think people mostly, I remember when I was on Wall Street, they'd say, yeah, options are invented by people who write them, they make the money, and those who buy them, 99% expire worthless, basically, right? But give it the layman's version of what it means, what an option is, how it works, and how the whole thing goes, basically.
Sure. Well, they're especially popular right now, folks, because of what Jordan just said about it's a derivative, which means that it is not stock itself. It is the right to buy stock, for instance. A call option gives you the right to control shares of Apple, for instance, instead of putting right now, Jordan, 1,000 shares of Apple's $350,000, right? Because $450 a share. What am I thinking? $450 a share, so it's $450,000 to buy 1,000 shares of Apple right now. But you could buy the right to buy Apple right where it is at $450 a share. And if you pushed it a month out, it would probably cost you $15 or $20 per option. Every option's for 100 shares of stock, so that investment might be only $15,000 versus $450,000 to buy the stock. But when you buy the stock, you own it. As long as that stock's still there, you own it. You get the dividends, you get all that stuff. If you own the call option to buy Apple at $450 for 1 month, you have 30 days, and that clock is ticking like this. And as it goes by, that's why Jordan said so many options finish worthless, folks. It's probably in the high 80% finish worthless, but at some point during that option's life, it may have been in the money by a lot, and then because stocks go up and down, maybe the option finished out of the money. So it's all about managing your risk, understanding time decay, which is, what happens over those 30 days from now till September. When those 30 days pass, that option is something or nothing. And if it's nothing, you lost 15 grand.
Do you recommend, so in other words, to restate that, so I think everyone was really good explanation. So basically, in other words, you buy an option, and the option, by definition, will always have an expiration date.
Yes, sir.
At some point, the option is basically no longer, you lose that right. You're buying the right to do something, right? So
correct.
If it's a 30-day option, right, that means that every single day, the value is getting less, the time value component, right? So every option's comprised of two things, intrinsic value plus time value, right? So if the stock, let's say you have a stock that's trading at $4.50. Let's use lower numbers. The stock that's trading at $40 a share. If you have the right to buy the stock at $35 a share, that means it has a current intrinsic value of $5, right? $5, because that means you could buy this. Someone who issued that option has to give you that stock at 35, and you can turn around and immediately sell it and lock in a $5 profit. That's the theory, right?
Yep, and that's the fact too.
And then on top of that, saying, but since I'm giving you this also, you have 30 days, you pay a premium on top of that $5, right? And so let's say it might be another $2 or $3 or whatever dollars on top of that, which represents the time value. And every single day that will kind of decay a little bit, right? Getting down to where it drops off really, really quickly at the end. And then if you're out of the money, meaning if the stock is below the call, it's worthless. If it's above, then it's got some intrinsic value that you can collect, right?
Right. So, for instance, last week, folks, Apple was trading at $380 a share, and then they had earnings, and the stock spikes up to 400, 410, 415, and it has kept going. Well, if you had the right to buy it at 380 and it runs up to those numbers, now you've got something that's worth a lot of money. There's no way you can make as much money trading stock when you're right as you can making money trading options because you've got leverage on your side.
Sure. Now, do you recommend that for, let's say, I wouldn't say just a beginner, but someone that's pretty, has some, acumen in trading options? Would you recommend, should it be 30 days? Should you buy out for 60 days? Now, what do you recommend is the best sort of sweet spot when you buy options, time value-wise?
A lot of what we do, Jordan, is following what we call smart money. So we're looking for the whales, somebody that's committing tens of thousands of shares, maybe hundreds of thousands of shares to a position. And so we want to coattail those people. Most of those people are trading in options that are 30 days or less. But that is also, just as Jordan said, folks, the steepest part of that decay curve. I mean, you can practically hear the value of that option decreasing as time goes by, just like a ticking of a clock. So it's traders on the floor, Jordan, used to go like air escaping a balloon, because literally that option is, just deflating as time goes by.
It's almost like that, like the cartoon, by the way. How about the cartoon with the ticking time bomb that ticks faster and faster as it gets down to zero, right? It explodes, right? That's it.
Exactly right. And so, if I were to counsel an investor on what they should do, I'd say more or less being out there 30 days to 90 days is the sweet spot. But when you're following somebody that thinks that they have either insider information or better information than you've got, because they've got people at the William Blair conference or at the Morgan Stanley conference listening to whatever the CEO is saying, then I trade based on those smart guys that have a staff of 20 people, 10 of which are always going around the country to those conferences to listen in on any tip that might be something that leads them into an explosive move in the stock.
Got it. Now, one of the things about options that I've always been intrigued by is that they typically are more, let's say the pros are not typically just buying an option. They're using strategies that are a bit more complex, and they're more based on hedging and sometimes being on both sides of the trade, like straddles or whatever that might be. Can you explain, do you do some of those strategies? Do you teach people those strategies? And do you believe there's one that really is, what would be the easiest one for someone to start using to make money, in your opinion?
Easiest one is just buying one option, for instance, at the 40 strike, to use Jordan's level of a stock, which might be like an Uber. Maybe you're buying the 40 strike call and you sell the 45 strike. So you've put out premium, you've paid for that 40 strike, the right to take the stock at 40. You've given somebody else the right to take it from you at 45, and you got paid for that. So that decreases the amount of money you've got at risk, and you've now got a leverage trade between 40 and 45. That's probably the simplest. We call that a call vertical spread or a bull call spread. And so if you're bullish, if you're on the right side of Jordan's table there, folks, and you've got the bullish feel, you put on that trade. If you've got a bearish feel, you buy a put and sell another put under the market so that you can profit from a downward move in the market. And we all know, because we see it all the time, Jordan, stocks go down faster than they go up. So a lot of the smartest traders on Wall Street really understand puts, because they can make a lot of, think of how much money was made in March on the put side of the market, but then vaporized in April, May, June, and July so far.
A very good friend of mine was one of the top, I'm sure you know him, I don't want to mention his name yet, but because it was a bad situation, but he had one of the most successful hedge funds in the country, one of the top performing last year, and he was essentially had a strategy. He was based on volatility. He was trading the VIX, and I know you know him, I just don't want to mention his name. He was one of the earliest traders on the CBOE. He was one of the first traders there back in the beginning, and he was basically having people buying spiders, which are like the S&P, the exchange traded fund, right? And then you put that, and he had that as margin. He trade volatility around that, and even getting extraordinary returns for many, many years. And then what happened was he got screwed when COVID hit, and all the firms started increasing their margin requirements, and they froze the market out. So I guess my question is that for most people like him, he's a professional. Right? I mean, he had become impervious to the emotional side of trading. How often do you see younger traders, like all these Robin Hood people that are out there right now, right? That they end up succumbing to the emotional side of trading. Even when you're telling them what to do, they go against, like they can't maintain that discipline, and they end up losing all their money. Not because the strategy was wrong, because they just can't emotionally handle it. Do you see that happen often?
All the time. All the time.